On March 11th, the Reserve Bank of India barred Paytm Payments Bank from onboarding new customers with immediate effect. Without elaborating, the RBI said it observed material supervisory concerns in the bank. The regulator also ordered a comprehensive audit of Paytm Payment Bank's IT systems. Vijay Shekhar Sharma holds a 51% stake in the bank and 197 Communications 49%. The restrictions mean users cannot sign up for new Paytm wallets or Paytm Payments Bank savings and current accounts. Meanwhile, sources told Business Standard that RBI's action was primarily owing to violations of KYC and anti-money laundering norms. The bank faced a similar action in 2018 after RBI found that it had violated KYC norms while onboarding users. Banking industry experts said the RBI had been strict in this regard in view of the Financial Action Task Force country review, which is coming up this year or early next year. Paytm has denied a news report from Bloomberg that said RBI found Paytm Payment Bank's servers were sharing information with China-based entities that indirectly own a stake in the firm. In the past, RBI has levied monetary penalties on banks for non-compliance with KYC rules. Earlier this month, 3 cooperatives faced penalties, while in September 2021, Axis Bank was fined 25 lakh rupees. Recently, fraudsters used the PAN numbers of several people to avail instant loans from the Dhani app. This has highlighted the need for stronger KYC checks. The objective of KYC and AML guidelines is to prevent banks from being used by criminal elements for money laundering. KYC procedures also enable banks to understand their customers and their financial dealings better, which in turn help them manage their risks prudently. Banks must ensure that no account is opened in anonymous or fictitious names. An account should not be opened when a bank is unable to apply appropriate customer due diligence measures, either due to non-cooperation of the customer or non-reliability of the documents and information furnished by the customer. Customers shall be categorized as low, medium, and high risk category based on the assessment and risk perception of the bank. So, what are the challenges that financial institutions face when trying to implement RBI's KYC and AML guidelines, since lenders are being frequently fined for lapses?
What do you mean by knowing your customer? One is, who is the true identity of the customer? Who are the beneficial owners of that accounts? Why is he opening an account? What is the source of fund? And what constitutes something called, we call it in our parlance as the reasonable account activity. This information should be collected and also verified. Digital transactions, which has picked up specifically in COVID, lockdown, etc. Right? However, these innovations could probably also have introduced certain new vulnerabilities and complexities into the overall ecosystem. So what the institutions need to focus on the real question: are my systems, the backend systems and processes and framework that have been put in place effective and in line with the changes that have been made at the front end, especially when I'm introducing a new product or a technology? The second is, are the banks aware of the possible new money laundering trends or techniques, and are any steps being taken to prevent them? The second most important aspect is obviously your transaction monitoring. With this increased volume in COVID of digital payment, the changing pattern of customer behaviors, and the new emerging risks that are detected, are you able to identify the red flags using the traditional transaction monitoring solutions? Is a question which we find that is becoming increasingly difficult for many of the financial institutions. So at the end of the day, if you don't have effective controls, your AML controls framework will not be really effective. Whether you like it or not, compliance is not an option. So whatever is the cost, you'll have to incur that cost. That's number one. But what also banks needs to look at is, how are they actually implementing it? And to answer your question, yes, the costs have gone up.
In an increasingly digital world, it is clear that banks must find innovative ways to assess customer risks and monitor transactions. Financial institutions, that is both banks and fintech companies, should understand the complexities that arise from both the volume of transactions as well as the volume of KYC data as we undergo a digital transformation.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.